This tutorial is going to be saving you a lot of money because so many beginners end up paying a lot of money to just learn about the forex trading. But in this tutorial, I'm going to be giving you all that information for free, and you're just going to be learning everything that you just need to know about the forex trading. And the end of it, I'm going to be giving you a strategy that will help you even to enter into the market. Let's get started here. My name is Dan, and if you just want to know more about this forex, I've shared a lot of tutorial on the YouTube. You can just go through that so that you can just know what we have been doing, how amount of money we've just been making, and this is going to be benefiting you a lot. Now let's start with the introduction of what is forex trading. So as you can see on the screen, we have introduction to the forex trading, of which forex is actually the exchange of currencies. You know, normally traditional we end that is called barter trade, where people used to exchange between goods and goods, but nowadays because of technology and all that, we have exchange of currencies. If you want to move from USA, you just want to go to the Europe, you have to exchange between those two pairs where we have Euro, USD, and that is what we normally call pair. For you to do forex, to exchange between two currencies, you need actually to have two different currencies of the different one, and that is the time you're just going to be doing the foreign exchange in that area. Now, talking about the forex trading, you can see the characteristics of it is actually 5 trillion traded every day. We have a continuous operation because you can actually trade 5 days a week, except for weekends, and that you're not going to be trading there. And then the minimum currencies comparisons over here is the return we have actually to pay the spread. The spread is actually the amount of money that you pay to the brokers that will be helping you now to trade into the forex market. There's difference between investment and the trading, because so many beginners ask me what is the difference between the forex trading and investing, because so many people want to invest in forex trading and all that. So investing is actually different, because when you talk about investment, we are talking about where people hold money for the longest time to make like a certain percent at the end of the per annum, end of the month, end of that. Investing on forex trading is different, because when you enter into the forex trading, you are looking to opportunities where the market will just be moving different. Here you can make money with a market that moves even than a minute, second, even less than 1 minute, and they will just be there making money into the forex trading, and that is going to be very interesting for you. So forex and investment is actually very different. Now we have someone that is called a broker. Who is some broker? So many traders and beginners think that a broker is actually someone that is the middle, like someone who is introducing you to the forex, of which is actually different. A broker is actually the platform that will help you to deposit withdrawals, and you offer with different currencies, commodities, and stock, so that you'll be able to now trade using your mobile phone, using your laptop at home, and that is going to be very interesting for you. Now, the FXPesa is one of the brokers that I actually use. If you want to get started, all you just have to do is to just register in the link in description of this video, and you're just going to be getting our free classes that we normally have. Now, the broker that we have like FXPesa is just going to provide you with the currencies of foreign currencies, indices, commodities like gold, silver, coffee, cocoa. We have stock market where you can trade like Facebook, you can trade Tesla, you can trade KBC, you can trade Safaricom. You just be seeing all of those stock market in that below. Now, broker also will just help you with the support. It will offer you anytime you have troubles like all that, they will offer you in the education and all that. Now, the broker also is very important, because the participants of the forex market, normally we earn the banks and people, we earn a lot of money. We earn the hedge funds, who people accumulated money into the pool so that you can enter a big position into the market. Now, brokers are here actually to help you as a retailer to make sure that you can even trade with your $10 there by offering you what we call a leverage. Now, leverage, because the highest leverage that is allowed for the brokers that are regulated in Kenya is 1 to 400. Why? Because so that they can just be helping you to regulate the amount of money, that you have, whether it's just small, you'll be able now to enter into the market. For example, when you have a leverage of 1 to 400, if you put your $100 there, that means you'll be trading with $40,000. It's not that you see that amount of money into your balance, but in real sense, you'll be on a position that requires $40,000, and you'll be able to enter in that position. There are a lot of positions that are needed into the market, but leverage is the one that you boost you to fit in that level of trading into this forex market. We've been diving deeply into the leverage so that you can just know how it's just going to be helping you on that area. So those are how the brokers, rather that you just be getting into the brokers, you'll be getting the platform to trade as well, and that is what we started by mentioning on that. Now the currencies that are trending into the market, you can see we have different, and actually you have like major currencies, we have minor currencies, of which if you just want to differentiate this, if there any currency that contain USD, like Euro USD, USD JPY, all those currencies are the major pairs. All those are major pairs. Minor pairs are pairs that don't contain the USD inside those pairs. For example, we have the Euro GBP. That is a minor pair. We have something like USD. We have a pair like Euro JPY, Euro CHF, which is Swiss franc, and others. Other minor pairs, and that we can just differentiate between them. Now, as we started by saying, we have different participants in the market: banks, investment funds like hedge funds, where they put the money into a pool so that they can just trend, and also we have the retailers actually just are the ones that can just be moved into the market as well, like you. So there are lots of participants into this forex market. That is what we actually have to know. Now let's just talk about the position that you can just enter into the market, because the market will just help you with the different opportunities that you're going to be seeing into the market, and you can just be entering into the market. The moment you just want to buy into the market, you can enter into the market immediately. Even on now, you can just go to the market and then execute your order, and the order is just going to be executed directly. And we have other pending orders. Pending orders are the one that you see the market will come to at this position, and now you put a pending orders. When this market come to that level, and then you can either whether you place and buy the market to buy, when the market reaches at that level it will buy, or whether you place the market to be selling at that level, it will be selling at that level. So you have two opportunities here. You can put an instant execution where you have market price, you can buy at the market price, or you can put an order that is going to be pending, of which is going to be buying later on, of which is then just going to be staying into the market. The other orders that you actually have to know is what we call the stop loss and take profit orders. When you talk about the stop loss, it's because the market is actually different from gambling. Gambling, you don't have stop loss into all that. In the market, in the forex market, you can be able to put your stop loss. You'll be able to put your take profit, which means I want to make $5. I want to, the maximum I want to lose, like let's say my target profit is $1,000. I want to target $1,000. Now the stop loss that I want is actually $200. So which means if the market, according to my analysis, I'll set that when the market hit $1,000 profit, it will close automatically. Whether I'm there or whether I'm not, the market will close automatically. And you can place what we call the stop loss, because the moment the market goes against you, you'll be incurring losses. And that losses, that means I'm going to regulate the amount of money that I can be losing into the market, which means now I'll be putting like $200. The moment the market reaches negative $200, then the market will automatically close, and it will just, you incur that $200 that you place, and you're not going to be incurring more than that loss of that. So that is the difference between take profit and stop loss. The moment you set that, then the market is just going to automatically reach your levels and close all those positions, of which is very, very important. So you make sure that you that is put your stop loss and take profit into the market. Now, if you just want to make money into the forex trading, all you just have to do is to do technical analysis. You put your orders there, and then you just wait. As long you have analyzed the market fundamentally and technically, just using simple analysis, you just have to wait. The market, whether you bought, you just have to wait the price to go up, and then you can just even close. You just wait for your take profit all. The other thing that you're just going to be happening here is that you can just wait for the market to be reaching your take profit, or you can close anytime you see, whether because maybe there are some changes you see happening to the market, you can decide to close at any profit that you just get. If your take profit was to 1,000, you can even close at 700, the way you just want. If your stop loss was at 200 and you have incurred $50 stop loss, and you see this market has changed direction and truly is going to reach my $200, you can close at that. So that is the important of the forex market than other things. Now, if you see this with what we call a pair, if you see something like GBP USD, now that is what we call a pair. And we have the base currency, which is actually quoted. The GBP is actually normally the GBP is the base currency, and we have USD, which is the quote currency, and that is the price. For those who are in Kenya, if you see something like USD, KES, and it is written at 160, that means for you to buy $1, you need 160 Kenya shillings. Now, you'll meet so many different terms into the forex market, of which they are very, very, very important that you're just going to be seeing here. For example, you're going to be encountering the term going long or going short. So when you just see something like going long, is actually means buying. You just want to buy into the market. If you just want to go short, that means you just want to sell into the market. Bid and ask price are just different, because the bid is what you sell in pair is usually than the ask price. So the ask price is actually the buying price, and buy the currency pair at higher than the bid price. So it's like ask price is the buying price and bid price is the selling price. So the difference between that is what the broker just offer. The broker will offer you between bid and ask price, so that anytime you are buying and selling, you just be selling different. So the difference between all that currencies is the price that you pay for the broker, and that is what normally called the spread. On the leverage, we are talking about leverage because this is what the broker offers you, so that you can just be using the small amount of money you are depositing the broker, you be high volume. So we have something that is called the pips. Pips are different because you can see whatever you just have here, like GBP USD, all these values, the moment they change the values here, those are the ones that are called pips, and we'll be learning how to just calculate all those pips and all that. Now, if you want to analyze the market, you need something that we call the price action candlesticks pattern, and that is called the technical analysis. You need technical analysis for you to be able now to analyze the market. Technical analysis involves the where you just refer the historical data, so that you can know where the market is just be ending. So historical data is just going to be helping you a lot into the market, for you to be able to know where this market is just be ending in future. That is going to be very important. And one of the things that are very important in technical analysis is actually the price action. So if you are a beginner, you actually want to learn more about the price action candlesticks pattern, which involve like candlesticks pattern. We have chart patterns, and that is going to be very important. So price action contains candlesticks pattern, chart patterns, and also a lot of things that you're going to be seeing here. Now, let's start with the price action to see what types of chart we have here. You'll be inquiring to see the moment you can select between this chart. It's called the line chart, because you're going to be seeing something just like this, how the market has just been moving, and you can just compare the prices on this side. Right side, on this side, you'll be seeing the values, and the down side where we have horizontal here, you're just going to be seeing the date and the time, or where the prices were. On the vertical here, you're just going to be seeing the price at which the price was and where the price is currently at. Currently, we have the bar chart, which are just shown. So these, you're just going to be selecting the bar chart. This is how they're just going to be appearing. Most of the traders like us, I prefer like trading with the candlesticks, because these are called the Japanese candlesticks. They are very common. So many traders love these because these candlesticks show different emotion. They just show how people are trading. They show when the market is going, when the market is moving fast, and all that. So mostly we will be learning more about the candlesticks when the chart is in terms of the candlestick. So you can select on this any broker or with any platform they're using to analyze the market in terms of technical analysis, and here you can just be using something like those candlesticks pattern. Now the first thing that you have to know as a beginner is actually how to draw the trend lines, and that is to find the support and resistance. Finding support and resistance is just going to be so effort for you, because it's just going to be helping you now to identify the market. I as well use the trend lines. I use the support and resistance to make market decisions, and that is going to be helping you so much. So you can see we have these candlesticks like this place here. I'll be showing you that when we go to the real market, because at the end of this presentation, I'm going to go to the chart so that I can show you the analysis, and we show how you can just use all this technique to enter into the market, and that is going to be helping you so much in that area. Look at this. We have where we can have like major resistance levels. That is where you can see a very big move where the market has when you go to the highest time frame, you see where the market support. So when you talk about the strong support, is where the market was trying to go down like in this position here, and the market was trying to go down across this area, but the market resisted and reversed from that position and just went up. When we talk about the resistance, we are talking about the market that was going up, and now it has been resistant on that area from moving up. So the market trying to move up, and then it gets resistant, and the market now reverses from that area. So the reason we just call that one a resistance zone is because the market is normally resistant that up 2 times. So then when the market resistance at that level 2 times, then that becomes a support, or it becomes a resistance point. Because you can see, for example, this one, you can see this line here, the market was reaching at this area and the market reversing back again. If you look at this, you can see the market was reaching around this area and came all the way again here, and then market reversed and went back again. So you can see the major resistance tested many times here. We have 1, 2, 3 and 4 times. So this becomes the major resistance zone. So because it tested more than one, so we have 2 where it can be tested twice, which is going to be, if you're going to be entering on that, then that is going to be the minor one. So the major one is where the resistance level is tested more than like 2 times, because there is a chances if the market was coming to that area, reverses back, coming that area, reverses back, coming to that area again, and reversing back again, that becomes the major. Either it can be resistance or the support area. So you actually have to learn on how to just identify this resistance and support area. So on the resistance side, we are talking about the market on the level, at a level, then the market is resistant, that is prevented from going up from that level, and the support area with their market was ending down, but it receives a support from that level. But remember, that support level, when you draw an horizontal line, is just going to blast with the other, and that level is going to be the support area. So that is the easiest one to identify the support and area. Now, how are you going to be trading on this? First of all, we have something like bounce. When this market comes and hit you, for example, the market was around this area and that was your support area, then the moment the market hit your line, for example, around this area here, assume this strong support here we have, then someone is going to be entering across this position that you see here, and he is going to buy when the market reaches across that area. And after buying from that area, then he is going to be waiting for the market to go now up, and then he's just going to be making money from that. There are a lot of things, because we have also the trend lines that are moving just like that on the distance that are vertical, just like this, and the person can just be selling anytime the price is at that resistance level, and then he can just be making money from that area. Now this is what we call a trend line. A trend line is a line that connects 3 point, and it connects either resistance or the support area. So you can see this market is moving up, and because you can see it is moving what we call high and highs and lows. So how to identify high and lows? Where you can see this market is moving up, and we have this market forming something just like this and moving up to this. So this is support area and moving high and forming another high low. So as you can see right here, we have these support areas that we have. Like this market has touched this region that you can see here. So this becomes the support area. And we have another one which is across this area. This is a support area. And this market is actually moving up, which means now after connecting these three dots and the market touching anytime it touches this now become a very valid trend line where the market shows that is actually going very up. Now we have these different types of trend line because these are where the market is moving just like this up. So this is called the uptrend, which is forming high lows that's shown. Now we have the market that's moving on the sideways, and the market that's moving on the sideways, that is the market that's actually ranging, of which means the market is not on the uptrend and the market is not on the downtrend. The market is just moving on the sideways, just like that. And that is what you can just be learning from that. We have different things that you can just in the market, like candlesticks pattern that you're just going to be seeing into the market, where this market will just be seeing different candles. Like we have where the candle, you see the candle forming a green because this is a setup. That means that candle, which means that now the market is on green. That means the market moved up. And when you see the market moving, forming this red candle here, it means that the market was moving down and it closed when it actually moved down. So the closing of this market was actually down. Now we have all these things that you see where we have like the bull and the bear market. So anytime you hear something like the bull market, that is the time you know the market is actually moving up, because on the bull side, you can see how the bulls move like this, and the bear is actually on that, just like that. So you can just relate on that. The bull market is the market that is on upside, going upside, like the uptrend market, and bear market is the market that is actually on the downtrend. So the downtrend and the market that is on the uptrend, that is what we call the bull, and the bear market that's just going to be getting around that area. Now on the market, when you're doing all these things, technical analysis, you'll be needing what we call the technical indicators. Technical indicators are the indicator to just calculate and mathematically, and they will just be helping you to now navigate and know how the market will just be moving and all that. It will just help you to analyze. So after doing all those support and resistance area, you can hunt different indicators to confirm your entries. For example, here we have what we call the moving average. If you use the moving average, for example, the 50 because you can just set, all you just have to do is to go to your settings. You can go to the platform that you can just be using here to do your things like analysis, and the moment you just go into that, then you just be seeing something you call the technical indicators. You can just be handling like moving average. Moving average will just be helping you to know where the market is heading, whether the market is on downtrend or the uptrend. For example, on this moving average, you're seeing the support areas, and you can see the moving average is actually being hit like all these points that you can see. So this and this. So most of averages that you see, they will act at the support or the resistance levels, and they're just going to be amazing. Now, technical indicators, we have like RSI. So one interesting fact about the RSI, it will just give you the strength of the market, how that market is just going to be used. So we are going even to be analyze the market. We are learning here to analyze using the technical analysis. We'll be putting even the RSI support and the resistance to see how we can just have a good entry into the market and to see whether it actually just work. So on the RSI, which is called the relative strength index, it has three support line here. We have the upper line which is 70, and remember you can just have to type relative strength index and then you and you have 70 mark, which is above. We have the middle one, which is 50. We have the below one, which is 30. So the moment the market crossed below 30, that means the market has been oversold and is ready to go up. When the market crosses 70, the market is overbought and the market is ready to go up. When it is 50, the market is actually, the price is just stable. The price is neutral and all that. So That is what we call the moving average. So we have something like MACD. This is an indicator you can just be used. It's normally act like RSI, because the moment you just be getting these two lines, the one that is brown is known as the signal line, and we add other the MACD line. But of these two lines, they are made of two different moving averages, of which if they cross below the zero line is actually at the center here. If they cross across this area, like the one that you can see across where my pen is, where my tool is, around this area here, you can see the moment they were reaching around this area, the market was around this position here, and the market now started buying. You can see another one when they were crossing across this area, and the market started selling. So the moment they cross above the zero line here, and they are just like this, when they are pointing downwards, then it's the signal for the sell, and when they are pointing up and below signal line, then is a point of buy. Like this one, another one here where it is presenting the buy, and this is the Euro USD, as you can see. So that's another indicator that you can just be using into the market. It's just very important. Now chart patterns is part of price action, which is very important, because now we have where we are talking about the support and resistance. That's why we start in the support and resistance levels, because they are very important and you're going to be using them here. So on the support and the resistance here, we're just going to be prompted with double top, and double top where you just be having like a two support with two resistant point that you're just going to be getting in the market. For example, you can see this market was heading up just like this, and then it hit this level that was eaten across this area, and the market now reversed back and broke this. So we have this market moving all the way here and moved, reversed from this position and hit on this and all that. So as you can see, we have the point we call the neckline. This is the neckline that we actually have here, and this is where the traders most enter after the breakout of the neckline here. Then you can enter a sell. So all these things you can just identify the market the moment you become familiar with the chart patterns, and they're just going to be helping you so much. The double top and double bottom work the same, because you can see this is just the opposite of the double bottom that you're just going to be seeing in the market. We have end and shoulder. End and shoulder is just the same as this. You can see how it's just forming the end and the shoulder, which means the market was reaching across this area, moved to the end. This is one shoulder and the left side, and this is the end, and now this is the other shoulder, and the center line here, between two shoulders down the chest there, then that's where we get the neckline. And the moment the market breaks around this area, now so many traders prompt to be selling the market, and that is what you call the end and shoulder. So that is very important thing that you actually have to be noticing there. So we have like the rising wedges. A rising wedge is where you can see this market moving on the resistance point, moving just like that, with support trend line that moves just like this. So on these two trend lines, when they meet just like that, then it means that they're going to be the market where it is going to break this wedge, and the market is going to be edging down. So the moment you see something like into the market, then you anticipate for the market that is going to be selling all that. We will be we'll see how we can just identify all these patterns into the market. We have different triangles into the market. We have something like this triangle here, which means that the market is on the range, where you can see the market. We have the support, like this is for a ranging market, but anytime you'll be seeing them break out of the market because of this. So it's where you can see all this support and resistance, they are parallel. The market is just within this triangle, and anytime you're just going to be seeing breakout upon. normally if this is happening after a very long buy, the market is going to be going down. And if it has happened after the market has been on a long sell, the market is going to be buying. Now we have this range that is across this area. We have this line that is moving up, and the other one moving just like this is called a bullish triangle. Then it is a representation that the market is just going to break that zone and going to be moving high. Now that is the technical side. We have also fundamental analysis that can just be affecting the market, like interest rate decision, inflation, and as well a lot of things like monetary policy that can just be implemented there into the market. Let me just explain the fundamental analysis of what we have interest rate and the inflation rate, on how they just the monetary policy, how they just come in, so that you can just be knowing the decision that is just going to be implemented in the bank here. Now we have something that we call the CPI. CPI means Consumer Price Index. So that is a rate that measures how consumers are consuming price from the market. So if these consumers, let me just put it here. So this is the CPI. So if the consumers if the CPI is high, that means the consumers have money and they are buying a lot of things from the market, and they are buying a lot of things into the market, and there is high chances that the price of commodities are rising from the market. Now, because of that, it causes the inflation to go up. With this CPI, of course, the market will just go up, everything will just go up, and it starts now devaluation the currency, the price of the currency, the value of the currency can now start going up, because all people have money and they are competing to buy at least one thing. Assume if this book was going at $10, everybody has money, this book, the sellers will actually prompt to be selling it at the higher price, which means the price of the currency, the value of the currency is actually just going down. So what the central bank do, they will come up with a monetary policy like interest rate, to increase the interest rate so that they can take some money from the economy, reduce the borrowing. If people are borrowing from the bank, and then it will just take money from the economy and then reduce the circulation of money, of which people now will not be having a lot of money into the market, and now they will just start now regulating that currency. Those is the part of the monetary policy they can just be taken from the market. Now we have something like export and import. They actually have to be balanced so that it can be having good economy, because with, for example, when we have high import than export or high export than import, is actually going as well to be impacting our currency either in a positive or a negative way. So those are the fundamental things that you just be looking at into the market, so that you just know if you'll be following on the interest rate, those will be good decision that you're just going to be implemented into the market. Risk management is one of the things that you're going to be anchoring in the market on the chart or the risk management areas. So risk management means if you are going to be risking your account, you have $1,000. That $1,000 that you have there, how much amount of money you're going to be risking? Are you going to be risking 50%? Are you going to be risking 20%? If you're going to be risking 5%, are you going to be risking 5% to get 2%? You're going to be risking 5% in order to get 10%. That is okay. You are risking 5% to get 20%. That is okay. But if you are risking 20% to get 2%, then that is not worth it. So those are the kind of risk management you have to take into the market, considering and all that, so that you'll be able to stay in there safe hands, and your money capital will just be protected. Let's just go to the chart so that you can see how you can just build a strategy and how you can just get started into the market, so that you'll be able now to start trading into the market. This is just going to be very easy for you. Come with me, we just look at this. Here is the real market. Now, as you can see, we have this pair is known as the Euro USD. So the pair you just see here is known as the Euro USD. You're just up here. I'm using one of the charts to just do all this analysis. Now, remember where we started by doing what is called the technical analysis, and we started by drawing what is called the support and resistance, and we went to trend lines. So these are the ones that are called the trend line, because you can see this is valid, because you can see it is actually connecting between these dots that you can just see here into the market. We have this market where it is actually touching this area. We have this region, you can see that area, and we have another area where the market has been touching across this position here. So this becomes a very good position. If you draw your trend line so well, you're going to be seeing that. And the other one that you guys going to see in the market is this one. So you can see the market touched around this area. So these are the ones that makes this line to be perfect and working trend lines. So all these of them, they are now valid trend lines. So if this market was just moving just like that, then you can see how we have good opportunity over here to be entering into the market. This valid trend line that's moving here, we have another trend line here because it has touched around 1, 2, 3 points. So anytime we be seeing the market touching our trend lines here, then we'll just be putting our entry positions, and then we're going to try to see whether we can just be making money from that. So let me wait for this market to touch at least one of our trend lines across that area to see whether we can just be having an opportunity across that area. So look at that. Look at that. So you can see the market that was touching this area, it has already touched our trend lines here, which means now the position that we're just going to be finding is the going. This is short position, this is long position. Long position we saying is a buy. So you're going to be entering the buy across this area here, and then you're going to be prolonging this because your TP will just be across that region, across that area, around this area, and your stop loss will be across this area. Stop loss means the one that is red is a stop loss, and then the TP is the take profit. Remember where we started on that. And our target here, you can see risk reward ratio. We saying you can risk to, because the risk reward ratio here is 2.5, which means it's just like on, if you are risking 100, you're going to, if you're risking $1,000, you're going to be getting $1,000, you're going to be getting $2,500 here. So you can now place after entering that trend to see the direction. You're just going to be getting into the market like that, touching, going all the way up. So you can see all that is actually the profit that you can see is playing into the market. Now it is already hit, and you can see now that how you just make money with that. Just knowing how to draw the trend lines into the market, that has already helped you so much. And you can see it has now already touched another point here, part of the trend lines, and the market is now going to reverse. If you want to add any indicator, for example, here you can be adding an indicator like let's see. You just come here and then you just add an indicator like RSI, and then just going to be helping you so much to either, you can see we have many of the indicators you can just be using here into the market to enter at the trend. This is the RSI you can just use, because you can see the moment this market was touching across all these areas, then it's just going different for you. We have something we call the time frame. Don't forget about that. So every candle that you see here, let me just log in so that you can see what the candle look like here, so that you can know how the candle just look like. So every candle that you can see being formed into this market is actually takes 4 hours, because you can see we have different candlesticks pattern. Here we have 2 hours. If you put like 1 hour, then it means for every candle that is just going to be formed into this market is going to be taking like 1 hour. So this is 1 hour, 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 1 hour. So those are hours. If you just want to like all this way, those took 1 day. If you just want to go, you can even go to the monthly, which means every candlestick that you see here represent 1 month. So you can see on this month here, I think is on October 2022, the market was on bullish. So that is the things that you actually have to observe. You can do what we call the top-down analysis. Top-down analysis means you start from analyzing from to see how the market has been performing in highest time frame, going to the all the way to the lowest time frame, so that you can know the position you're just going to be entering into the market. This is how you just analyze the market in a very simple way if you are a beginner, and then it's just going to be helping you so much. We have a lot of indicators you can just use. You can identify support and resistance areas into the market, including in the highest time frame, just like that, and the market is just going to be on the respect to that. The only thing that you actually have to do is to identify. You can be seeing where the market is crossing 2 lines, and you can try now to be drawing your support and resistance areas, and that is where you will be starting now to learn into the forex market with the indicators like symbolic band with RSI. The market is just going to be very simple for you. Now that is, if you're going through this video, make sure that you perfect everything that we have discussed here. It's just going to take time, but at least take time to digest all that, and you will be going far with this forex market. I hope that has been of benefit. Thank you so much for watching all this video. Make sure that you follow me everywhere. You can watch my videos that I've done 4-hour, 6-hour lessons to explain these things in details, and they are going to be helping you very much. Thank you so much. Bye bye.